Good morning, everybody, and welcome to our next webinar. And in this webinar, we're looking at IFRS 15, revenue from contracts with customers. And in particular, Kevin and I would like to assist you to do some risk assessment. Risk assessment, really trying to assess how this standard would particularly impact your organization. So as I would say, as always, it feels as if Kevin has been here forever. I welcome Kevin to the webinar as well, and the two of us will co-present. Just to put the webinar into a bit of perspective, in our February webinar, we talked about transitioning to IFRS 15, and Kevin explained all the complexities and how actual complex it is to do all the calculations and the journals. And he looked at the two methods, that it's a full retrospective method for disclosure purposes or a cumulative approach. Again, it's more a disclosure perspective. The calculations, doesn't matter how you disclose it, the calculations remain the same. And I think that was an important lesson we learned from that webinar. Now, in this webinar, we focus on risk assessment. And then in the April webinar, next month's webinar, we'll highlight some practical problems that we've encountered when it's assisting people to implement the standard, and also some other potential areas, potential implementation problem areas. So that's just to put the webinar into a bit of perspective. So if we look at today's webinar, the outline of this webinar, we'll start with doing risk assessment around the scope of IFRS 15, and then we'll do a risk assessment for steps 1 to 5, look at each step individually. We'll end off by looking at a risk assessment around some other areas like principal, agent, etc. And then right at the end, we'll highlight some next steps, and we'll give you some suggestions to develop a heat map for your organization to focus your time and effort, and therefore money, on the problem areas according to that heat map. So that's really what we plan to do today. As a bit of an introduction, if you've got a 31 December year end, we know you are already within the mandatory application of IFRS 15. Date of initial application for you would have been 1 January this year. And if you're a listed entity, 30 June this year, you would have to prepare your half-year results, and that half-year results would already be based on IFRS 15. However, if you've got a 30 June year end, you are heading towards the date of initial application 1 July this year. You are currently in the comparative year if you want to do full retrospective disclosure. I think important for you in your 30 June 2018 financial statements, we know that AASB 108 in paragraph 30 require you to disclose the fact that there are new standards and disclose whether you've started a process to assess how it will impact you. And I would imagine by 30 June, you'll have to have some kind of a quantitative assessment. That disclosure of the potential impact is also included in ASIC's recent media release around focus areas for 30 June. So that's just maybe putting the perspective around it and the urgency. As you know, IFRS 15 introduces a 5-step revenue recognition model, and we are going to work through those 5 steps today and specifically focus on how do you do a risk assessment on whether how influential or how problematic the various steps will be for your organization. So it's all about us asking questions today, and you using these questions to prepare a heat map for your organization to focus your time and attention. At this stage, I'll introduce Kevin or hand over to Kevin. Kevin will look at risk assessment, the scope of IFRS 15, and then I'll be back to look at steps 1 to 5.
Thank you, Aletta, and good morning, everybody. As Aletta said, I'll be looking at the scope of IFRS 15, and it's an interesting one from a risk assessment point of view, because I think the knee-jerk reaction is to jump straight into the standard and start working through the 5 steps. But from a risk assessment point of view, the scope of IFRS 15 is actually crucial. And if we look at the first slide, as with all accounting standards, they're designed in such a way that certain transactions or certain relationships don't apply or don't fall into IFRS 15. Now, this is quite crucial because the way IFRS 15 is actually written, it's written from the point of view that you need to go look in another standard first, if in some cases, and the best example of that is, let's say, lease contracts or insurance contracts, as on the screen. There are certain industries that are going to jump to another standard in its entirety before even coming to IFRS 15. Lease contracts, insurance contracts in the insurance industries, even some of the financial services of banks will go straight to AASB 9 for financial instruments. That said, there are other standards that are partially going to apply at the same time of IFRS 15, and this can present a real risk to some organizations. And the best example again is leases. The way the standard is constructed is that you could have a customer where you are selling to them in the ordinary course of business, but at the same time, there's a portion of the contract with them that is dependent on the use of a particular asset. And in that case, the lease standard, AASB 16, is going to apply at the same time. So they'll be partially within the standard 15 for revenue and partially within the lease standard AASB 16 for leases. Now, this is critical. It does represent a relatively big departure from the way things are done now. Generally now the way we do things is we kind of go to one standard for a transaction and we stay there. But because the standard is constructed at a contract level, contract basis, you could have situations where you're partially within the revenue standard and partially within another. On the other hand, there are other types of scenarios that are completely scoped out of the revenue standard, and you need to look at those quite carefully. Non-monetary type exchanges between parties. This one did come up in an example with us a couple of days ago, where you have a scenario where you're in a particular industry and supplying goods is perhaps maybe restricted by supply, but at the same time demand increases. So you enter into an arrangement with a competitor who helps you out when you don't have the supply, but you're trying to deliver or make good on a contract that you have with the customer. They'll let's say supply your goods when you don't have it in your stores, and they do. Those arrangements are non-monetary type exchanges. They're between entities in the same line of business to facilitate sales to customers. They're not part of AASB or IFRS 15. Likewise, which I'll get to in a later slide, are collaboration and participation agreements. And really, using participation agreements as an example, this is where you, let's say, have an agreement where you share the risks with another organization. And the best example is in the pharmaceutical industry, where you're trying to develop a new drug. Perhaps the one party has the intangible, the right to develop. The other one is doing the research. You're sharing the risks on the arrangement. It's clearly not a revenue transaction, or it's not a transaction from ordinary business. Sharing and collaborating and participating, you'd be completely scoped out of the standard. Now, those are just a very high level look at some of the types of arrangements that are outside the scope. But as I said at the beginning, is don't jump straight into the 5-step model. You really need to understand whether you're actually in the standard to begin with, or whether you're partially within the standard, especially when it comes to things like leases. So looking at the scope in more detail, what is a customer? This hasn't changed in substance from the way the current accounting standards work. So a party that has a contract with an entity to obtain goods or services that are an output of an entity's ordinary activities, highlighted in the slides, in exchange for considerations. So really, you're kind of taking a step back and saying, well, who are my customers? Who are the people I do this for, and who do I earn my money for? What's the ordinary activities of my business? That's my customer. And the reason why I'm putting this up on the slide first is because Aletta will get to in a moment the 5-step model, and the first step will be contracts with customers. But before you assess whether you have a contract, you need to understand who the customer is. So it's a bit of a 2-step model. Do you know who your customers are? And then do you have a contract with them? And you need to look at that quite carefully. This can become really interesting when you have, let's say, contracts with multiple parties. So we'll take, let's say, the travel industry or travel arrangement. You are selling packaged tours on behalf of an overseas travel provider. The question is, well, who's the customer? Is the customer the party you're selling the packages to, or is the customer the person that you're representing, who actually delivers the travel overseas? So are you their agent? This can be really complex when you've got agency and principal arrangements. Are you an agent for someone else, and are they your customer, or is the customer the end part person that you're selling the goods on behalf, and are you the principal? So do you know who your customer is? It can also get complicated when it comes to multiple arrangements or multiple contracts. Some contracts need to be looked at together, so multiple contracts will be added together or linked, because the arrangement cannot be understood without looking at all the contracts together. And then you start to have multiple parties involved. The question is, who's the customer? Who is the party that you're contracting with, who obtains your goods or services as an output of your ordinary activities? So that's something to really have a look at. So the last slide then on this section is the risk assessment questions. I guess the question is, do you understand your income streams? Which items are partially inside and outside the scope of IFRS 15? Do you have lease income, which falls into the lease standard when you have revenue, which is another part of the contract? Is there dividend income, which falls out of this? Grant income, this can be fun in the not-for-profit industry. It's absolutely possible that you can have some of your contracts in the not-for-profit industry as part of the revenue standard, and others part of the income standard, which are contributions and donations. So you could have some contracts in one or the other. And like I said, participation agreements, some of these are completely scoped out of it, depending on how you collaborate and how you share risks with the other party. That's a brief overview then of the scope. And as you can see, we haven't even started on the 5-step model yet. Aletta, I think I'll hand over to you then to look at the first step.
Thank you very much, Kevin, for looking at that. So if we now move on to the 5 steps, and you've determined and you've considered you are within the scope of IFRS 15 and you know who your customers are, in step 1, and this is a little bit of a recap of what we've done last year. I didn't want to just bombard you with questions. I thought, let me quickly tie it back to what we've done last year, and all the webinars of last year, where we said in step 1, you identify your contract or your contracts with the customers. And we've always said there's 2 parts of it. There's identify the contracts, but there's also, very important, consider whether these contracts should potentially be combined. And those 2 things form part of step 1 realistically. And you will remember that I've given you 2 decision trees over the months. The first one was around identifying whether we've got a contract or not. If you don't have a contract, you'll see if you answer no at any stage there, you don't have a contract with a customer under IFRS 15. You might have a legal contract for other purposes, but for the purposes of IFRS 15, you do not have a contract, and therefore no revenue can be recognized, so you don't progress to step 2. However, if you end up, yes, I have a contract, you move on to the next decision tree where you consider whether you should combine contracts. Now, we've talked through this decision tree in the past. I think the one to really highlight here is the question, the last question, which is it probable, more likely than not, more than 50% likely, that the entity will collect the consideration to which it will be entitled in exchange for goods or services that will be transferred to the customer? And really, we've talked around what checks and balances do you have an entity have in place to ensure that you are only selling to customers that are creditworthy, that will pay you, and that we can only say we've got a contract when it's probable that we'll actually receive that consideration in future. And that was a critical aspect, or a new aspect in IFRS 15. So I'm not going to talk through all those questions, but these are the kind of things we have to think about to see, do we have a contract, is there commercial substance to it, etc. You will remember then I then also gave you a decision tree around should we combine contracts? And the first issue here is, are we entering into contracts with a customer that at the same time or near the same time, right? And then if we say yes, we are, let's say within the same week, or the same day, or the same fortnight. You know, we talked about what does same time mean, but let's say it's more or less at the same time. Are the contracts entered into with the same customer or related parties of that customer? And if we say yes to that as well, we are saying, are the contracts negotiated as a package with a single commercial objective? And as soon as you say yes to that single commercial objective, the fact that we legally structure it in 5 different legal contracts or legal documents for IFRS 15 purposes, we look at the substance, and that all of those 5 legal documents are actually one combined contract for IFRS 15. Or maybe you said no, but the next question, does the amount of consideration that you pay in one contract depend on the price or performance in another contract? Again, there's interdependency. Yes, you have to combine it. And the last one, are the goods or services promised in these different contracts actually a single performance obligation? And therefore we should consider it as one. So for instance, as I said to you, and I think this was my example, if we did a renovation of a house, although there might be a contract for the kitchen and a contract for the media room and a contract for different parts of the house, you know, I think you get captured in so many different ways. Ultimately, it's for the renovation of that house. And, you know, potentially it's a single performance obligation because you're going to do the whole thing together because you're relocating and swapping the existing kitchen with the media room. You know, it's so interrelated that it's a single performance obligation. So in that instance, we have to combine contracts, and then we can move on. So really important to consider whether we've got multiple legal contracts with the same customer or related party of the same customer, and therefore the substance is we should treat it as one contract or one bundle of contracts, and that's really critical. So questions for you to ask yourself at this stage, and everybody will have different answers. Does the entity have any income streams which involve the entity entering into contracts where it's not probable that you will collect the consideration to which you'll be entitled in exchange for those goods or services? So I could add additional questions. What process do you have in place to assess at what stage it's actually probable that you will receive that consideration? Or is it a process or a credit check that you would never transact with somebody unless it is probable? But how are you going to convince your auditor around that step? So that's my first question. The second one, do you have income streams that involve your entity entering into multiple contracts with the same customer at the same time? Now remember, at the same time is a fairly broad interpretation. So do you have these multiple contracts with the same customer or a related party at the same time? Because you'll have to bundle them together. Substance, it's one. The third one, do any of the income streams involve negotiating 2 or more contracts with a single commercial objective? So really for the purposes of IFRS 15, you know, commercially how you structure, for legal terms, how many contracts you put in place. And I often see transactions where there are 5, 6, 7 contracts. But really, if you think commercially, what are we trying to achieve here? All of those contracts work together for a single commercial objective. And therefore, we should look at them and look at the accounting treatment of those together. And that's an accounting rule. It's not just limited to IFRS 15. The fourth one, do any of the income streams involve the entity negotiating contracts with the same customer where there's some kind of price interdependency? I thought at this stage I'll try and get some feedback from you, maybe focus your attention, and do a polling question. Everybody think about their organization. So do you enter into multiple contracts? So I just want to extract that a little bit so you should be able to see it nicely. So do you enter into multiple contracts with the same customer and there's some kind of price interdependency? We could make it a bit broader, where there's a single commercial objective across the multiple contracts. Let's just get an idea, and I think that will give you some idea how relevant this part is for you, and it would be, I think, interesting information. So at this stage, about 50% of you have voted. It would be interesting to see what you think. Let's see if we can get to 60% of you voting. Just think about your organization in general. Do you enter into multiple contracts with the same customer? And is there that price interdependency or a single commercial objective? Really, I'm asking, do you think step one and the potential identification of contracts and combination of contracts is going to provide any real issues for you? All right, we've got 60% of people have voted, and I'm saying thank you very much. And if we just share the result, at this stage, 34% of our attendees have said, this happens and we should look at it very carefully and investigate a bit more, I would say. 58% would be no and 8% unsure. Obviously, the unsure will have to do some more digging. For the 58% in the no category, I would really like to challenge you to rethink and assess whether that's really the case. In our experience, when Kevin and I speak to clients, this is actually quite prevalent. And, please pay a bit of careful consideration to that. All right. So if we move on and look at, before I ask further questions, I thought, Aletta, you should just maybe flag again contract modifications. Now, also as part of step one, in future, it could happen that you modify existing contracts with a customer. So initially you agree to do certain things, and 6 months later, a year later, 18 months later, while you're still busy maybe with the construction of a hospital, they would say to you, we now want you to add this on or change that, or even with a house. Could you, while you're busy, could you please render the outside of the house, or could you please, throw in that swimming pool, etc. So contract modifications. Now there's three very different ways that IFRS 15 deal with contract modifications. And therefore we've prepared a decision tree to help us on, how do we end up in the three different ways. Now the one way is it's a continuation of the original contract. But that's a hard way because you have to adjust the revenue that you've recognized to date, and you have to have a catch-up adjustment at that stage. You could have a termination, so we completely, we end the previous contract, and whatever's left unfulfilled on the previous contract or the original contract and the new one is grouped together and we start all over. Or we can have a brand new, separate new contract. And how to determine which of those is applicable? Your first question is, are these additional goods or services that you are going to provide distinct? If you say no, then it's a continuation, and then you have to do a catch-up adjustment. If you say, yes, it is distinct, so maybe you say it's a swimming pool, then which is distinct from the house, maybe. Then the next question is, does the price of that swimming pool, this new distinct good, reflect the standalone selling price of a swimming pool. Basically what they're asking are you giving this existing customer a good deal because you're already doing a lot of work for them, or are they paying a standalone selling price, a market value that you would have asked any customer? If you say no, it's not a standalone price, it's at a bit of a big discount, then it's a termination of the original contract, and whatever's left of the original contract plus the new contract, the new pool, would be combined, and that discount will be spread over the whole thing. If you say it is standalone selling price, so it's a distinct swimming pool, it's at a market value, then we just say that's a separate new contract. It actually has nothing to do to the original construction of the house or the renovation of the house. So you can see, even in future, when you make amendments to your existing contracts with customers, we come back to step one and say, how do we deal with that modification? So that is maybe just to give you a bit of perspective or background around it. So I've got a lot of questions around that. Do any of the income streams involve the entity changing the scope of an existing contract with a customer? So we're doing more work, less work, etc. The next question, question 6, does the entity enter into new contracts with existing customers where there are unfulfilled performance obligations, which means, I've got an existing contract, we are 60% complete with it, and now we are entering into a new contract with that customer to do additional things. So we're already busy with the construction, we're not done yet, it's unfulfilled, but now we're adding other things to it, because you would be captured by that decision tree on the previous slide. So also question 7, do any of the income streams involve the entity changing the scope of an existing contract, but that additional good or service are not distinct from the original product, from the original promise? Or maybe it is distinct. And then in the last question, we ask around the entity's standalone selling prices. So you can see all of these questions ultimately link back to help us to assess how this decision tree would apply to that particular modification, and therefore which of the 3 accounting treatments would be applicable. So again, I thought, let's get an idea on, to what extent this would be a potential problem. So I thought, let's ask a simple question. Do you modify existing contracts with customers? Is that something that happens in your business? Or is it, I've got a contract, off I go, execute and move on? So to what extent do you actually modify existing contracts with customers? I think it's prevalent in construction.
Aletta, I actually think it's probably prevalent in a lot of organizations, and one of the risks I ran into was a slightly larger organization. They've actually got managers who manage relationships with various customers, and what's actually happening is finance team doesn't know that modifications are happening at the manager level. Manager is managing the relationship, and therefore, you know what happens in that scenario. We give a little to keep the relationship going, and suddenly you have a contract modification, and the contract sitting at finance, but the relationship and the negotiation is happening, let's say at a branch level or between a manager, and suddenly a modification happens. Sometimes it's not even documented. It's just an agreed handshake, and a change happens. But that is a modification. It's a modification between the parties.
Kevin, you're absolutely right. I've seen that with a few customers as well. That is very true. Now, Kevin, while the two of us were chit-chatting away, 52%, 53% of our attendees have voted. And I think maybe we should call it a close. This is a close call here. So the question, do you modify existing contracts with customers? If I share the results, 44% says yes, or what they're aware of, Kevin, and then 49% no, that's not how we do business, 7% unsure. So I think what Kevin is saying, if I take it a bit further, for the 49% who say no, if you are in finance teams, and I don't know what team you are, I don't know how close you are to dealings with the actual customers, it's maybe to have a conversation and consider whether you've got all the information to have a confident no. But that's very interesting. Thank you very much for everybody participating. If we go on to the step 2, risk assessment, and first of all, as always, I'll give you a bit of background. So in step 2, we look at identifying the separate performance obligations. Now, I'll put up my hand, actually both hands, and say that step 2 is the one that I find hardest in practice, to identify the separate performance obligations. And I'm having conversations with various clients around this on, is the nature of our promise that we are promising one thing, or is the nature of our promise separate things? This is a hard question, and it really is dependent on facts and circumstances in a particular organization, and hard and fast rules won't work. Now, this decision tree, again, you'll remember from previous webinar where we try to give you some guidance to determine what is the nature of your performance obligations, whether it's one or various. And the first question we've set here is, can the customer benefit from the good or the service, whether on its own or with other readily available resources? If they can't, now definitely then this good or service is not distinct and it has to be bundled with others. If you say yes, they can benefit from it on its own or with other readily available resources, the next question, does the entity provide a significant service of integrating the goods or services? Now, often this is a very prevalent question around software and software implementation, but it could also be in other areas. Again, if you say yes, there's the significant service of integrating, then it should be bundled. If you say no, next question, do this good or service significantly modify or customize other goods or services? As soon as you say yes, you have to bundle. If you say no, another question, are the goods or services highly interdependent or highly interrelated? Now, if you answer yes to those 3 questions, you don't have a distinct performance obligation. You should bundle it with other things, and quite often you end up with one big performance obligation. If you say no to those, you end up with that particular good or service is distinct and therefore a separate performance obligation. So that is old news. Let's look at risk assessment questions flowing from that. So really, the first one, do any income streams involve the entity bundling distinct goods and services in a single contract? So as soon as you in your business talk about bundling, I think you should be on high alert and maybe assess. The next one is also around bundling. Do any income streams involve the entity bundling goods or services in 2 or more contracts that have to be combined, as we discussed in step 1? Sorry, I just want to, I can't remember whether I've actually shared the results. I just talked so much. Then if we go on, question 3 to me is actually a really important one, and one I encounter quite a lot. Do any of the income streams involve the entity providing any, I would say, so-called free services to the customer? So, you know, we give you free training, like this webinar, or free installation, or free updates, or free help desk. And, you know, I've framed it there around software, but there are other things that you potentially give your customers for free. And therefore, we have to think, you know, if it's for free, nothing is for free. So what are we talking about? Is it a separate performance obligation for IFRS 15 purposes? And then the fourth one, do any of the income streams involve the entity providing any goods for free? Again, you know, as soon as a client is telling me that this is what we sell, but we also provide customers all these things for free, you have to ask, you know, why do they give it for free? Is it a separate performance obligation, or maybe it is part of marketing? You know, so and that's acceptable too. So really that notion of free has to be challenged, I would argue. Then some more questions. Question 5, do any of the income streams involve the entity granting customers substantive rights? Now, substantive rights would be if we give them discount vouchers that are substantial. So a 50% discount voucher, if you buy one dress and you come back within the next 30 days, you can buy a next one at a 50% discount. Are there any renewal rights? So you've got an option to renew a subscription, but is the option to renew the subscription at a market value, or is the option to renew at a hugely discounted amount? So as soon as we've got those substantive rights, you know, that substantial discounts or lower prices, we potentially have separate performance obligations. The sixth question, and I don't know what happened to number 7. Number 7 is missing. Funny that it is number 7. Question 6, do any of the income streams involve the entity granting the customer a warranty? Now, this is an interesting one. At the moment, if you provide a warranty, you would have said a warranty is outside the scope of the revenue standard. I would apply AASB 137 provisions to it, and I would create a provision. IFRS 15 is changing that. As soon as you provide a warranty, the question would now be, is it a normal assurance warranty that we continue to recognize in terms of AASB 137 as a provision, or is it maybe a service warranty? Now, a service warranty would be something over and above a normal warranty that usually goes with a product. So, you know, I buy a washing machine, there's a normal warranty that it will work for a year. That's an assurance warranty. You create a provision if they bring it back in the next year. However, if the customer can also buy an additional warranty that that machine will continue to work for another 4 years, that warranty is actually a separate performance obligation under IFRS 15, and revenue recognition will not be at the date of the sale of that machine. So if you currently sell products, goods or services, and there's a warranty attached to it, I think you'll have to do some thinking around whether it's a service warranty or an assurance warranty. So I'll flag that. We don't have a missing question 7. Question 8, do any of the income streams involve the customer paying monies to the entity where it's not receiving a benefit? So that would be something like an activation fee, a mobilization fee, a joining fee, an upfront license fee. So there's a payment of money from the customer to the organization on day one. Often they would say it's a non-refundable fee. We have to look at those carefully. Non-refundable fees are not recognized when we receive it on day one. Nowhere in these 5 steps is there a reference to the date of cash received. So if we've got that scenario where there's some kind of cash upfront payment, we have to still ask, so what benefit did the customer get at that date? What performance obligation did we satisfy at that date? Maybe just activating them is not a separate performance obligation, but actually providing the service over a period of time is the performance obligation, and it should be spread over that time. So if I'm a member at a gym, I'm telling you, whenever I pay a gym a joining fee, it's like a waste of money immediately because they never see me again. Which is a bit scary, but even though the gym can't recognize it on day one, because at that stage they've not provided any service to me. They've just signed me up, taken my money. If I've signed up to go to the gym for the next 6 months, Their performance obligation is to stand ready, have the gym open, and you know, I might just walk in over the next 6 months and ask them to allow me to use the gym. And question 9, another question: do any of the income streams involve the entity providing a license to the customer? If you're providing licenses to a customer, there's been a lot of debate around it. There's no clear guidance in the current AASB 118. In the new IFRS 15, when it originally came out, there were application guidance around licenses. Within a few months, there were additional guidance added. I would say most of the work I'm doing around IFRS 15 to date has been around licenses, software companies, how do they recognize revenue. There's now a lot of guidance. So definitely something to look at. I thought I'll ask some questions at this stage to just see to what extent the identification of performance obligations would be a potential issue for you. And the first one is, do you provide so-called free goods or services to your customers? And I suppose if you provide it for free, one would think around, therefore, is it marketing that I do? Or, you know, why am I doing it for free? Or is it actually as part of a contract? And as part of a contract, I'm going to do certain things and I'm saying it's for free. However, I'll have to allocate part of the transaction price to that, because nothing's for free, especially if it's written in a contract. It's definitely not for free. Thank you very much. Many people are voting, Kevin, so that's good. I know you can't see it, Kevin, but I can see it. So we've got 60% of our people have voted. So interesting to see, and this time I'll share the result. 37% of attendees are saying, yes, we provide goods or services for free. 54% are saying, no, don't do that. 9% unsure. So again, if you do, or if you're not sure, this is something to investigate a bit further as you get ready to transition to IFRS 15. If we go on to step 3, now in step 3, it's all around determining the transaction price, and this is the total transaction price. And why I'm going on about that is, remember, potentially in step 1, we've combined a number of contracts because there's an interdependency, or they negotiated at the same time, and one commercial objective. So all those contracts, let's say 5 contracts that we've combined, each one of them have a transaction price stated in them. All of those are now added together to get one overall transaction price for that collection of contracts. So our transaction price is the amount of consideration the entity expects to be entitled to. Remember, in step 1, we said it has to be probable that we'll receive it. And what consideration do we actually expect? So we consider, will there be volume rebates? Will there be settlement discounts? Will there be penalties if we deliver late? Will there be rewards that we receive if we deliver early? We have to consider all of those. And then as part of transaction price, there can be a fixed bit, but there can also be a variable bit. The variable bit is those penalties, rewards, a number of variable aspects, and we've discussed that in our webinars. When we look at transaction price, there's a lot of things to consider. And I know we've discussed it, you know, is there a financing component in there, especially if the timing of the cash flow is very different to the timing of the recognition of the revenue, and there was a kind of guidance, if it's more than 12 months apart, you know, Do we think there's a financing component in there or not? What if there's non-cash consideration? They pay us by giving us an asset. Yeah, then we fair value that asset if that's how we do business. What if we pay consideration to a customer? If we pay that consideration to a customer, then we deduct it from our revenue potentially, and we have to think about that. Variable consideration, do we know whether it's going to happen or not? And there's something called constraining estimates of variable consideration, and I'll move on to that. Now, that constraint is if you've got variable consideration, if we said yes, there's variable consideration on the right-hand side of this decision tree, you have to estimate the amount of that variable consideration or your transaction price around the expected value or the most likely value. The most likely value is if there's only two alternatives. The expected value is there's a range of alternatives and you'll apply a weighting to it. But then your next question is it highly probable that a significant revenue reversal will not subsequently occur? And the whole purpose in IFRS 15 is we do not want to recognize revenue and then in future have a reversal. So therefore, before we book revenue, in step 3, we ask, is it highly probable that there will not be a reversal in future? Now, highly probable is not just more than 50% likely. Highly probable is a higher threshold. More than 75%, 80%, there's no guidance, but, in my head, or Kevin and I are thinking, more than 75% probable that the revenue we book now will not be reversed sometime in future, then we'll include it in our transaction price. So, for instance, if we know, we're not going to be on time, therefore we're not going to earn a certain reward for being on time, and the probability of being on time is really low, then we won't book that reward amount. And then the transaction price will only be the fixed component. So questions around this for you to consider around step 3. The first one, do any of the income streams involve variable consideration? The second one, do any of the income streams involve the entity providing a price concession of any sort to the customer, because that's a variable consideration? Will any income stream be impacted by that reversal constraint? And that's saying it has to be highly probable before we take that variable amount into consideration. And what evidence, I want to add that, what evidence do you have to support the fact that it's highly probable? Because your auditor will ask for evidence. And then question 4, do any of the revenue streams involve the entity making payments to its customer? Because when we make these payments to a customer, it's not automatically a reduction of revenue. There's a process to go through. Am I making a payment to the customer for a distinct good or service, a separate transaction? Or, am I making a payment that's related to this revenue? And we have to consider a number of things. I'm just trying to identify here, or help you identify, which aspects you should investigate further. Maybe there's a few ones that you say, oh no, definitely we don't have it, but let's consider, because your auditor will ask you these questions anyway. Do any revenue streams involve the entity receiving non-cash consideration? Because then you'll have to come up with a plan how you're going to determine fair value that will make your auditor happy on you've got enough evidence. Question 6, do any of the income streams involve a significant financing component? So if there's cash up front and revenue will only be recognized in 3 years' time, does that mean there's a financing component in it? Or you sell goods today, but they only pay you in 2 years' time? Are you providing financing to them? And then the 7th question, and this time we have a 7th question, do any of the revenue streams involve the entity providing customers with a right of return. And again, you know, we'll have to, if there's a right of return involved, not a definitive answer, we'll have to investigate facts and circumstances a bit more. If we go on to step 4 around allocating the transaction price, we know that you've got this overall transaction price, and important, irrespective of what values are written into different performance obligations, different contracts. That's not how we do it for IFRS 15 purposes. We have the total in step 3, and in step 4 we allocate it based on standalone selling price. And there are some guidance on, if you've got a standalone selling price that's easy to obtain, you use that. Otherwise, you have to estimate a standalone selling price, and there's a few methods you can use to do that. So some questions, and I think this time I only have 4 questions. Does the entity enter into contracts or, you know, combined contracts, as we discussed in step 1, which more than one performance obligation has been identified? So as soon as you've got more than one performance obligation, you've got this problem. You have to allocate the transaction price. You know, if you've linked contracts in step 1, you now have to allocate a transaction price potentially over not the contracts, but the performance obligations identified in the linked contracts. Then also, will the unbundling of contracts into separate performance obligations mean that consideration will require that allocation? And then also, are there follow-on impacts from step 2, where it was determined that bundled goods and services are not distinct within the context of the promise to the customer? So all of these questions are trying to say, as soon as you've come up with separate performance obligations in step 2, whether it's separate performance obligations in one contract or separate performance obligations across a number of bundled contracts, this step would be of relevance to you. And you have to think how you're going to do it. Now, step 5, finally, we can talk about recognizing revenue. We've done a lot of work now. We've done a lot of assessment. And now we get to the nitty-gritty. When do we recognize revenue? Now, the principle is we recognize revenue when a performance obligation is satisfied. So the question really is, the key question is, does the entity transfer control of the asset over time? Yes or no? If you transfer control of the asset that leads to this revenue recognition, if you transfer control over time, then you would recognize revenue over time. And if you say, no, I recognize it at a point in time, then you would recognize revenue at that point in time. And there's a number of considerations on when that point in time is. Is it on day 1 or day right at the end? How do we do that? I think it's important to say here that the general principle in IFRS 15 is that you recognize revenue at a point in time. That's the rule of thumb. You recognize revenue at a point of time, and then you will have to assess what is that point in time. However, if you want to recognize revenue over time and you want to move away from that general principle of recognize revenue at a point in time, there's only 3 ways to get to over time. And you have to be able to answer yes to one of these 3 questions. And we've discussed them around, does the customer simultaneously receive and consume the benefits provided by the entity's performance as the entity perform? Your typical service arrangements. If you say yes, then it's over time. If you say no, does the entity's performance create or enhance an asset that the customer controls as the asset is created or enhanced? And the example I've given you, if a builder is building a house on my property, on my land that I own, that I control, or if a software developer is developing software, customizing it, installing it on my premises, so I control it as they progress. Or the last alternative, if we've got a specialized asset where there's no alternative use to us, and it's an important and, we have an enforceable right to payment for performance completed to date. So there I always use our own firm and auditors as an example. If you do an audit of a particular entity, there's no alternative use to that audit. You know, you audit, you provide that audit service to a particular client. You know, if you get 90% of the work done, but you never issue an audit report, you can't use that audit evidence and apply it to another entity. It just doesn't work that way. So we've got a service that has no alternative use. And then the second question kicks in: does the entity have an enforceable right to payment for performance completed to date? So I say to audit partners, if you've done 90% of the audit, but for some or another reason the client you know, the client no longer require you to issue an audit report for whatever reason, do you have enforceable right for payment for the 90% of the work that you've done? Or do you only have an enforceable right to payment once you've given them an audit report? Because if we've got an enforceable right to payment for whatever work we've done to date, then we would say we can recognize, BDO can recognize the revenue over time as we conduct the audit. So you can see it's quite hard to get to recognizing revenue over time, and it's all around recognizing revenue at a point in time. And if that's the case, what is the appropriate point in time? So some risk assessment questions. I'm a bit conscious of time. You know, questions will be, will the impact of determining certain performance obligations not to be distinct in step 2 result in certain goods being recognized at a different point than under current practice? So step 2 creates some issues. If you are now combining different services or goods and services into performance obligation, how does that change your recognition of revenue compared to what you currently do? Question 2 is, I would say, similar. Question 3, does the entity construct assets at a location other than the customer's premises? So do we construct assets at our location? Because then we're not meeting that second step in our decision tree. Do customers have the right to return a product? And the fifth one, do we enter into bill and hold arrangements? Because questions 4 and 5, all of that has some impact on what is the point at which we can recognize revenue. At this stage, if I move on to the next slide, does the entity sell licenses? Again, licenses have a big impact on step 2 and step 5. So if you sell licenses, you'll have to genuinely, seriously consider steps 2 and 5. Is it likely that all or some of the performance obligation will change from over time under current practice to a point in time under IFRS 15? Can you get a sense that the way you currently do it is going to change? Question 8 is the other way around. And then question 9, in step 2, were any issues identified in respect of the customer not receiving a benefit for services it was involved for? So connection fees, etc. Now at this stage, I thought I'll throw out our last polling question for today. And I'll just say, do you sell licenses to customers? If you say yes, you would have to pay very careful consideration to IFRS 15, particularly steps 2 and 5. As I've said before, Kevin and I are working very closely with a lot of our clients around licenses, where they're selling licenses. So definitely that is something that you will have to look at. So at this stage, about 50% of our people have voted, and around 14% have said, yes, we sell licenses, and they've just made a note they have a lot of work to do. Kevin, if I can hand to you to look at risk assessment other, you've got about 30 seconds, Kevin, no pressure, by the way.
Oh, that's fine, Aletta. So look, just looking on other, if Aletta can move to the next slide for me. This is probably just a sweep slide, just to pick up some of the issues that might have been mentioned already, or maybe we haven't addressed in the presentation. I think I did a deal with agent and principal right at the start, where I mentioned, you know, who are you? Are you the principal in an arrangement? Are you acting on somebody else's behalf? I think the point to note here is, generally under the current standards, we generally look at transactions at an agent or principal level, whereas in the new standard 15, we look at them at a performance obligation level. So there is the possibility that you are actually acting as an agent for some performance obligations in a contract, and in other cases you're actually acting as a principal. And a good example of that is where you manufacture goods, you're selling them to customers, but then you as part of the contract say to them, all right, I'll arrange transport for those goods. Not always that you're going to be an agent, but you could be. You're an agent because you're arranging transport to get the goods to them, and you're the principal in terms of manufacturing. So some of the income streams may be impacted by the agency principal arrangements. And this also pops up where there's sort of 3 or 4 or multiple type parties involved in arrangements. Just need to look at that and bring that into your assessment. The other one is contract assets. We haven't looked at that too much, but it is something that's starting to rear its head. The new revenue standard does actually deal with recognizing contract assets. So that's similar to, let's say, inventory. As you capitalize inventory when you're developing a product, there is a section that deals with contract assets. It's not designed to replace other accounting standards on the recognition of assets, but it is designed to pick up those costs that relate to a contract with a customer that are not dealt with another accounting standard. So you could end up with some expenses that you currently expense that are related to a contract with a customer that you currently just expense, which aren't capitalized under an inventory standard or another accounting standard, which under the new standard you might end up capitalizing and recording those as assets for the duration of the contract with the customer. And then lastly is breakage. Do you have any revenue streams with breakage? And these are things like gift cards, vouchers, loyalty programs, all those types of things where you promise to provide something to an entity going forward, a future good or service, but it's subject to breakage. Things like the customer is unlikely, or some customers might not actually take the offer up. Some of them will expire. You know, you've got gift vouchers that have a 3-month period. The customers aren't really going to take them up. It's going to expire. Those are breakages, and that will impact a number of the steps through the 5-step model.
All right, thank you very much, Kevin. So if we look at next steps, now we've asked you some questions to try and guide you on areas that you should be working on. Next steps, practical next steps, I do believe that you have to prepare a individualized heat map risk assessment for your organization. Now, if you go on our website, and I've given you the link there, you will see that we have prepared some heat maps to give you examples of heat maps. We've given you on that website, there's a tab for AASB 15. There are some steps to implementation, questions you should ask. You know, do you have the systems, the processes in place to capture all the information you have to capture going forward? We've got some industry heat maps. There's an IFRS 15 fact sheet. You'll also see that we will be launching a number of articles over the next 2 to 3 months where we provide examples and suggestions around the various steps. So if you're not signed up to receive any of our particular newsletters, at this stage, if you contact me or email me, definitely will sign you up. It's just aletta.boshoff@bdo.com.au, and you'll also get those. They'll also go on the website. as we do that, if you want to use the website as your main point of contact. Kevin, we've talked about these 5 things in our webinar in January, so I think I'm going to leave it as is and just say, you know, just a reminder that we have to start to think in terms of our business model, read as much as possible around the impact on your industry, what other people have put up around how would it impact your industry, develop your proof of concept approach for each revenue stream, how you're going to do it, make some decisions around automation, and consider and assess whether you do need some help. So do you need assistance? As you know, we've got the monthly webinars. We will launch some further articles. There are some in our BDO news. Next month webinar is around problem areas, practical problem areas, implementation problem areas. And if you want advice, you can contact any of us. Kevin is based in Sydney. I'm looking after Melbourne and National. Wayne Basford, our colleague in Perth, or Clark Gerald in Brisbane. And again, I've given you there a link to our contact details and where you can find more information. And that's our wider team. So I've run over time. I do apologize. 5 minutes over time, but you're used to that by now if you're a regular attendee. I can't contain myself to 60 minutes. So thank you very much for joining us. Thank you, Kevin, for sharing your wisdom, knowledge, and we hope to speak to you again next month. Thank you very much.